The Tax Lady with Esther Gulius and E.G. Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, my friends, this is Esther Gulius, the Tax Lady. And this is our hour to talk taxes and all those kind of subjects related to money, and we'd love to hear what you have to say. And I know the IRS has just been pummeling people with letters this week, so if you're one of those that got a letter and you want to talk about it with Auntie Esther and the crew, 803-0930, 803-0930, star 930 on a cell phone, and I got in studio Tiffany.
Hello, Esther. I also want to say go Bills tomorrow. I think that's very exciting.
It is just so exciting. You know, I've lived in this city for like 38 years, or 39 years,
right?
Because I'm originally from Detroit. And initially when I got here, I think Bethlehem Steel was closing up, and I thought, oh, gosh, what kind of a place did I move to? But, you know, the people of Western New York are wonderful, and they have more resilience when you think about, and the waterfront, and we're going to build the bridge, but we're going to fix the water, and nothing ever happens. And to think that stuff is happening, to see a crane in Buffalo.
I know.
I mean, you almost want to jump out of the car and say hallelujah.
Yeah.
You know.
And then Mr. Pagula is.
I love Mr. Pagula. I've never met him, but if I ever saw him, I'd drop to my knees and say thank you, Mr. Pagula, for having more faith in us than most of our leadership does.
I know this is not what we're here to talk about, but on Facebook, my daughter showed me Mr. Pagula's daughter put a post on Facebook, or her father did, and she said, my daughter is thrilled that we got the bills, but I said to my daughter, what are you so thrilled about? Now I'm broke. So it was so funny.
That's so great.
Right,
and Christopher Fabian. Hey, Chris.
Hello, Esther.
But I mean, it is pretty exciting.
And
don't
Chris
you think?
is going to the game tomorrow.
You are?
Yep.
Well, they better darn win. That's
just
all
for
I
me.
got to say. They better darn win. I mean, it's exciting. Anyway, I'm Esther Gulius, the Tax Lady from E.G. Tax. We love Buffalo. We love you, and we want to help you. 803-0930, 803-0930, star 930. I know nothing about sports, basically. So we're not here to talk about sports, but we are here to talk about your tax situation, your money. And every week we kind of come up with a topic, and our topic this week is people are always talking about, should I sell my house? What happens if I sell my house? When I sell my house and my mother gave me, we're going to talk about that. But before that, we have our tax school, right? That's almost ready to start.
That's right. It starts the middle of October, pretty darn quick here, and it's in 3 different locations. It meets twice a week, either in the mornings or the evenings, whatever is more convenient for you.
And we have the online class.
And we have
too.
the online class. It
come
costs
to class,
nothing for
come
the
to class in your underwear.
Just have to buy the book. You also get continuing IRS education, which is wonderful. Credits. Yep. So a great opportunity.
And we're really proud of that. I mean, to have a continuing education unit, we're a local company, and we have a wonderful writer who writes our books. The IRS, Tiffany's in charge of the continuing education units, and we're really proud of that. So you can come to our classes and get continuing education units if you're a tax professional and you need those. If you take the class, we'll provide you with that.
That's right.
And if you want to register, you can register online by going to egtax.com.
Yep, that's right. Or you can call the office, 632-7886, and we'll mail you a registration, or we could register you right over the phone. And I got to say, I've been here 10, 11, 12 years, and the hope is
10 or 11 or 12, Tiff. How many years?
It's been Gracie's 14. It's been about 12 years.
And that's very good.
I can tell you that our hope is that you become an employee, and that's our hope.
Right.
So.
People say, why do you do this for free? Because we're very greedy, and you might have 150 students in class, and you might take the top 25 to keep your staff bolstered, because some people can't come back, or some people move to Florida, right, whatever. And then, Chris, and then we got our E.G. Tax Business Services Solutions.
Business Solutions. It's a great program to help people, with every step from starting a business to running your business. We'll sit down with you, make sure you're the right entity whether self-employed, corporation, LLC, to see if that's the right one
See,
for you.
because you can be operating a business, and that'll be fine. The IRS will accept your return, whether you're a sole proprietor. But maybe the better thing for you is to become an LLC. Or maybe the better thing from that is to become a Subchapter S. Or maybe you're a C Corp, and you should be a Subchapter S. And that's part of what we do for you, right?
That's right. And not to mention, we also do sales tax returns, which are due the 20th of this month. So probably Friday, right? 16,
Right.
17,
15th is Monday.
Yeah, so you got to come get your sales tax done. We do
And many
payroll.
of you that are self-employed don't even know, but you're supposed to be collecting sales tax. And you need to get, and that's part of what we'll help you with too. If you're somebody that's just running a small business and you're not collecting sales tax, well, you're just waiting for the state of New York to like stop at your door and say, hi, you owe us 20 quarters of sales tax.
And the
And
penalty
here's
is
what
nasty.
this is, and here's the penalty. And we want to straighten you out with that too. Right?
Yep.
Oh,
Yep.
New York State loves their sales tax, and so you want to make sure you're doing what you're supposed
Wait,
to
New York
do.
State loves. You can take
Money.
off the word sales. Just leave the word tax. on
Yep.
there,
And
right?
also, those who filed extensions for their corporations, they're due on Monday.
Yep.
You know, you have one more day to get them in.
I have somebody
Right.
who emailed me one on Friday. So
That's right.
He's
and
thinking
then
about
and
it.
then and personal returns are due October the 5th.
October the 15th,
Right.
yep.
All right, but our topic of the day, and again, if you want to give us a call, 8030930. Maybe you're somebody that's gotten a letter. I think, what was the big letter we got this week?
Stocks.
I know, but how much was the biggest wrong balance due that people got?
20,000 something.
Right, and what did they really owe when they got done with this?
The IRS owed them.
Well, that's good. So basically, the IRS, to get your attention, they run what all the information that's been given to them on their computer. They compare it against your tax return. You didn't add some stock sales in because you didn't think that it was really sold because you really didn't get the money. It was just what you thought was rolled over. They send you a bill for $20,000. After you do the Schedule D and you compare that against your cost basis, you may owe nothing.
Right.
And so don't pay the bill.
Don't pay the bill. There's a client we do, and he's disabled, so I actually went over to his house in Cheektowaga and picked up the bill 4 days ago, and sure enough, it said he owed $18,000, and the same thing. And he's like, oh, my God, I'm so nervous. But we looked at it, and it was some stock that he got when he sold a house that he inherited and the basis, and so he owes nothing.
Isn't that great? Yeah, the matter of fact, I had a lovely couple that I loved to death. They're my client. And initially, I think they got a bill for like $30,000. And so, of course, it was stock, and we fixed it. So yesterday he comes in, and he says, well, they're down to $800 now. It's going down from...
Whittling it down.
Right. So, and then what they had done was they forgot to adjust when they sent him the bill. The extra income that they had imposed upon him made his Social Security 85% taxable when it really wasn't. They kind of forgot that. So when they sent him the new bill, so then we sent him the computation, and so
I heard you say that yesterday. Now I get it.
I said they're whittling it down here.
Right.
From 20,000 down to 800, we'll get them down to zero. Anyway, I'm Esther Gilius, the tax lady from EG Tax, 8030930, 8030930. We're going to talk about all the things related to houses, rental property, selling, inheriting, gifting, so that, because a lot of people talk about that. And I know we have people holding. We'll see you on the other side. We're going to take a short break for commercials. We'll see you on the other side.
In the nation, they go by Guardian, Lifesaver, and Friend. At Nationwide Insurance, we just call them agents. We put members first because we don't have shareholders. Join the nation that cares.
Nationwide is on your side.
I have an insurance agent who cares. That's why Bill Barber has been my agent for 15 years. For any insurance needs, call Bill. 688-2199.
Nationwide Mutual Insurance Company and Affiliates, Columbus, Ohio. Subject to underwriting guidelines, review, and approval.
He's going back in time for me. See it in your eyes. All right, who is it, Chris?
Come on, you got to get this one.
Don't know.
America.
America.
Well, see, now if you would have said Canadian or
There we
Canada.
go.
All right. Well, we want to thank our two new sponsors, Dr. Nancy Mufali. She's a lovely dentist. And, I mean, I have to tell you, there was a time in my life that I don't think I had gone to the dentist in like 7,000 years. And finally, I talked to a nurse for a dentist, and they came down and got me one day. And I said, you have to spend like a whole day with me because I knew there was bad things going on. And it is so great. I'm no longer afraid of the dentist. And Dr. Nancy Mufali is a wonderful dentist, and we thank her for coming in and to being part of our sponsors. And Went Propane, I think we talked about them a couple of weeks ago.
Yep.
I mean, I was paying $3.15 a gallon because I live in an area of propane, and I saw all around my neighborhood people had went. So I thought, all right, I'm going to call them. They said $1.89 or $1.98 or whatever the heck. I said, you're kidding me.
At Amerigas.
Right. Oh, Tiffany.
Whoops, somewhere.
But anyway, that's a lot of money in a heating season. So if you're in a propane area, give Went a call. Right. And we thank them for being our sponsors.
And
All right.
I also wanted to say Dr. Mufali is a general practitioner dentist, so she does a great job if you need your teeth cleaned, if your kids need your teeth cleaned and cavities.
Or if you're like me and you never want to go to the dentist.
Or, plus, don't want to sound, what's the word I want to say, but when you got to go with people who are young, who aren't afraid of the new technology.
Hip.
Mm-hmm. You mean she's like cool?
Yeah, but like
don't say like me.
No, I wasn't going to say
but
like you.
But you keep pointing your finger at me.
I was going to say there's someone we all know that had eye problems, and
my husband.
Yeah,
it's true. My husband was with an older eye doctor who was a wonderful man, but he wasn't with the new technology, and we were in Florida, and I said, why don't we go to Florida? There's probably more old eyes in Florida than anywhere in the world. So we went, and what was going to be this big procedure up here, I have to tell you, and the doctor had him done in 15 minutes with laser because that's the new thing. And so it's really important. Healthcare is moving as fast as what's happening in the tax industry. So, all right, we're going to go to the phones, and then we'll talk about houses, and we're going to talk to Doug in Williamsville. Hey, Doug.
Oh, hi, Esther. Thanks for taking my call.
Our privilege, our pleasure. It's a privilege. It's a privilege. How can we help you, Doug?
Well, I hope you can answer this question. I received a settlement from a bankruptcy proceedings from 13 years ago, and the question I have, I received it as a creditor, and they still owe me money. But obviously I'm not going to get the rest of it back. So 2 questions. 1, do I owe taxes on the money I received as a creditor? And number 2, since the bankruptcy proceedings is now ended, can I now write off the rest of the money that I was owed as a creditor?
Okay, so it really depends on the nature of the debt. In other words, if it were a non-taxable event to begin with, then the income that you get is not going to be income. In other words, let's say that you sold a personal residence that you were holding the mortgage on that wasn't going to be taxable, okay? And now you get part of the proceeds that wouldn't have been taxable, then it's not going to be taxable now either. However, if it were a personal residence, then you wouldn't be able to take the loss because losses on personal residence aren't deductible. But it depends on the nature of the debt.
What did you get it for?
Right.
What did you get the money for, Doug?
The money was essentially, it's an LLP. It was money paid in to become part of the LLP. And this is, I think, some of it's 13 years ago, so it's tough to me to recollect exactly.
All right, so somebody was going to be a shareholder, correct?
Yes.
All right, and so this was money to buy into the company.
Correct.
That they never, ever paid you.
Never paid me back. I was a full shareholder, but because of the bankruptcy, they could not pay me back entirely what I paid them.
Okay. Did you ever send to the IRS a debt forgiveness form, a 1099-C?
My tax accountant said since it's not settled, and just settled recently after 13 years, she says, we have to figure out what to do now. This is 13 years henceforth. We're not sure what to do.
Okay, well, on a bankruptcy, if the person that was the debtor, it's not going to be taxable because forgiveness of debt on a bankruptcy is not taxable. But because you never got the income and they never were a shareholder, then it's not going to be income and it's not going to be deductible.
So it's not taxable, but it's not deductible.
Right.
The remaining.
Okay, except that did they ever own? Did you ever treat them like they were a partner?
Oh yes, I was a partner.
They were a partner. All right, so then that would be then it's like sale. That's like sale of the stock. So it'd be capital. It'd be a long-term capital gain. So you have to go back and find out what your adjusted basis is. What you really got for it would be probably less than your adjusted basis. So it probably isn't going to be taxable, but it needs to be reported on a Schedule D.
It was like he should have got K1s in the past.
Well, no, he is the seller.
Okay.
So always have received K1s, and the K1s have been basically no for many, many years until this recent.
Well, let's just put it this way. Let's say that the share that they bought was supposed to be $10,000, and your basis in the company is $10,000. All right, and they gave you $8,000. In essence, since you sold them something that had a higher basis than what you're getting for it, it's not going to be a taxable event.
Okay, yeah, because I essentially paid 8 times the amount I'm getting back.
And then the question is, all those years that you weren't giving them shares in the company, do you have to go back and give them a percentage of the company?
No.
No. So, all right. So as long as your basis is higher than what you're getting for it. However, if your basis in the company is 0 and they gave you $10,000, then it would be a taxable event on a Schedule D.
Okay. Yeah, I think I understand that. So now the question might be if to prove that from 13, I have to find records from 12, 13 years ago.
Well, but your accountant should know that because they would know. Like, for instance, pretty much I don't have much of a basis in EG tax, I mean, because I built it like from nothing, and everything I put into it, I've depreciated. So there really is no basis. So if I were to sell a $10,000 share, the whole thing would be taxable because I have no basis.
And then I wonder if you can dig up one of those old K1s, and on there it would say what percentage owner he is, right?
But he never gave it to me because he never paid him.
Okay.
But the basis, your accountant's going to know what the basis is.
She's always had the K1. She's always asked for the K1, and she's good records of it. She said the K1's very key, and I said, all right, I'll leave it up to her.
I'm sure your accountant's going to know. If you need any help, just give us a jingle, okay?
I appreciate it.
Thanks, Doug. Bye-bye.
What a good question.
I'm Esther Gulius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. Yes, Christopher, I can see. I can see.
Cancellation of debt is it's very interesting whether you're the receiver of the cancellation debt or the person who was the canceled debt was. Where if he was in business and he used the accrual method, so then
that's true.
Then the income was already counted because it was billed.
But it doesn't sound. But it was a sale.
This was a shareholder. Right. But that's what I'm saying. Anytime you get a cancellation of debt, whether you're the person canceling it or you're the one that initiated saying I can't give you any more money, call us and we'll tell you what it's going to look like on your tax return.
But in this case, it sounds like he was selling a portion of the business. Right.
Yep.
Okay, and we're going to go to Guy in Kenmore. Are you Guy or Guy?
Guy.
Guy. Hey, Guy. I'm Girl.
Hi.
How are you?
I'm good. I'm good. I have a question regarding my deferred tax credit that I'm getting for my health care for Obamacare.
Okay.
I based that on an estimate of my income of $25,000 for this year.
Okay.
What I've been doing over the past couple of years is converting a portion of my traditional IRA to Roth, which obviously creates a taxable event.
Right.
That. At the end of the year, do they differentiate between that kind of taxable event as income with my normal income, or is that going to really, kill me with the tax difference?
You really have to be careful with that because if you're getting if the federal government is helping you with your health insurance, part of your adjusted gross income is going to be that pension distribution from your traditional to a Roth. So you have to be very careful with that, Guy, because that could really affect your subsidy. And when it comes time to do your tax return this year, you might end up paying back that entire subsidy.
And then, Guy, if you wanted to, just a suggestion on Monday, you could call me at the office and I could do a conference call with you and Tim to pinpoint exactly if that Roth conversion is going to add to the
Right, but have you done it yet, Guy, this year or not?
Not this year because
Well,
I didn't know.
well,
because
what-
I've heard it's a tax defer. It's not a subsidy.
No, but the thing is, it's all based upon your total income, your total household income, and that is definitely going to affect your household income. So what I'd suggest you do is we can do a three-way between you and our
Health
navigator. Well, he's not a navigator, but he's like, he's like the trainer
Or
that
I
trains
was
the
thinking
trainers.
of calling Christine, one of the navigators.
Well, that's true. And then we can tell you how much it would affect your subsidy, because it'd be a terrible thing if you're getting a $4,000 subsidy. You do your Roth conversion from traditional to Roth, and it eliminates your subsidy, and you got to pay back the whole subsidy just by doing a conversion. It's just not a good time to do it.
Okay, so they don't differentiate, even though that money is not technically coming to me at all. They don't.
Right.
They don't
But you have to
differentiate
understand, Guy, it's all based upon discretionary income, right? So you have the right. That is your money. And so that's still money that you're putting into a taxable vehicle. So it's all adjusted gross income. So what I'd suggest you do is call 632-7886, 632-7886 on Monday, and Tiffany will put you in with our specialist, okay?
Thank you very much.
Thank you, sir. I'm Esther Gulius, the tax lady from EG Tax, 803-0930, 803-0930, star 930 on a cell phone. We're going to break for news. We'll see you on the other side with your questions. Bye-bye. Well, could it be the banana breads? How about the toilet seats? I don't know.
Nothing?
Tyler.
Oh, it's the Killers.
The Killers. I just came up with
The American Killers.
They were a fad
I don't
for a
know
while.
why you-
Wow. Wow.
just abstract names. I don't know if you know, Tyler. Okay, I'm Esther Gulius, the tax lady, 803-0930, 803-0930, star 930 on a cell phone. We got Chuck. Hey, Chuck, how can we help you?
Okay, hi. How's everybody today? Thanks
Good.
for taking the call.
Yeah, what can we do for you?
So here's what's going on. I just sold my father's house. He passed a while ago, and we sold the house, and I just received the check from the realtor after everything was paid off. And my name was actually on the deed as well, because my parents had set up a life estate years ago, and then my mother passed, we took her off the deed, then my father passed, and we sold the house.
Okay.
So I just received the check from the realtor about a week ago, haven't even cashed it, and was wondering what my tax liabilities are going to be on this.
This is so perfect because we wanted to talk about this. This is probably one of the biggest conundrums that people come up with because this happens a lot. Okay, so had you inherited the house and your name was not on the deed, then your cost basis for selling the house would have been what it was worth at Dad's death. But that isn't what happened. You were on the title with both mom and dad. Did both mom and dad retain ownership, or was it strictly in your name?
No, it was in. We took my mother's name off when she passed years ago.
How long ago did she pass, Chuck?
My mother passed in 2003, and my father passed last year.
Okay,
and,
so she was on the deed.
Your name was on the deed the same
so
time.
So the
Mom's
three of
name.
you were on.
And my sister.
4 of you were on. Okay.
Correct.
So all right. So when
did they buy the house?
The house was purchased in 1961.
Do you know what they paid for it, Chuck?
$19,000.
What kind of improvements did they make monetarily? Capital improvements? Just a rough guess, just for our sake right here, right now.
Fixing the kitchen, new bathroom, new
landscaping,
garage,
roof,
furnace.
Boy, I'm going to probably say maybe $30,000, maybe a little bit more over the years. It has
all right, let's say 40.
On and on.
So let's say 40. All right. So when Mom passed away, in 2003, what would you think that the value of the house was then?
Oh, probably low 100s, low 120 maybe.
All right, and at that point in time, she was only a 25% shareholder, right?
Correct.
Okay, so that would mean that mom's basis then was 32.5, dad's basis is 20, so your adjusted basis then would be 52.5. Now, did you and your brothers or sisters after dad's death put any other capital improvements into the house to sell it?
Yes, I have one sister, and we did. We put capital improvements and
about how much?
I can tell you, we put about $15,000 into the house.
Okay, so then the adjusted basis then is about 67.5, and your in the expense of sale, there was a realtor involved, et cetera, et cetera.
Yep. All that was paid before we even got our check.
All right, how much did you get in your check? What was your net check?
My net check was $69,911.
All right, so there was there was a mortgage?
Nothing.
Okay, so
no,
but you got half. Okay,
I got half. My sister got the other half.
1912. Okay, I'm doing my ciphering.
Did you
here.
each get 69, or you got half of that?
No, he got 69. She got.
That's what I thought.
Okay, so your gain is about $72,322 each collectively. So divided by
about
2,
$36,000.
about $36,000. All right, now let me ask you this: is your income? Are you married, Chuck?
Yes.
Is you and your are you and your wife's income taxable less than $72,000? This would be after itemized deductions and personal exemptions.
Yep.
Okay, so
we're gonna be over that
because of the house, right?
No.
All right, you're over that. Okay, but how many children live in your home?
None.
All right, just you and your wife?
Yep.
All right. So if you're over the 15% bracket, right? Then they're going to then
you're going to pay 15% tax
on
that
the
$36,000
plus the state of New York.
So about
let's say
$5,400 to the federal, and 7 times 3, about $2,300 to the state.
Right. So about $7,000.
Okay, about $7,000.
State and federal. Right.
Now, did you or your sister live in the house with Dad for the last couple years?
No.
Okay. All right. So that's about it.
Actually, my father was in assisted living since '05, and I had tenants in there to rent the house.
Oh!
Now we just changed
wait,
the picture.
we just changed the answer. All right. So if the house had retained its personal characteristic, then what we told you was correct. However, once you turned it into rental property,
and then he sold it.
All right, then all the depreciation that you claimed also becomes income.
At least it wasn't for very long.
So how many years did you rent it out for, Chuck?
Well, we had tenants in there about 4 years, but that money went to pay for my father's.
I know, but that doesn't change the fact that the house was depreciated, and that depreciation has to also become income. So assuming that the depreciation was $3,000 a year times 4 years, that's another $12,000 or $6,000 apiece for your sister and you and extra income. So that will hoist the thing up another $3,000.
So you're saying I have to bear the tax burden on the income that I received renting it?
No, you have to bear the burden on the depreciation claimed on the rental portion when it became rental property. Because I'm assuming you and your sister took the Schedule E on your personal returns, right?
We haven't yet because
who claimed the rent?
Who claimed the income?
My father.
Why? It wasn't his house. It was only partially his house.
He got all the money.
Okay, so then when did his name come off the title? After his death.
He passed.
Correct.
So, but you were still at 1/3. So it's still going to end up. It's going to be part on Dad's, part on yours, and part on your sister. But it's going to be an extra $3,000 between the three of you. And in other words, you have kind of a plate of spaghetti. And it's obviously going to be more complicated than the average tax return.
No.
So what I'd suggest you do is to get it done, get most of it straightened out before tax time, so that you're not under the gun by April the 15th.
And I don't want to add more worms to your big can right now.
Yeah.
But were you renting it after Dad passed away?
No.
So as soon as Dad died, you stopped renting it?
And put it up
Well,
for sale.
actually, I lost the tenants about 2 months before my father kind of took a turn for the worse. So and we knew it was coming. So my priority obviously wasn't
Let's
on
take
the
care of him, right?
house.
Sounds like they
It was
fixed
on
Okay,
my
but
father.
what you might want to do, Chuck, and we don't charge to do this. You might want to come into the office, bring copies of your tax returns, and then what we'll do is a preliminary worksheet, so that you can see how much goes to your sister, how much goes to you, and how much goes to your dad's final return.
Okay.
Okay?
And I would cash the check and put it in the bank. And
That's for sure.
start
That's
collecting
right.
interest on it.
But I guess really, we were saying about 7. I'm thinking that each of you is going to end up owing about $8,200. All right, you and your sister. Actually, we considered all the gain to be he and his sister, so maybe not so much. Maybe $7,000 you,
Because it's
$7,000
three
your sister, and part's going to
Your
go to
dad's got
Dad.
to do a final tax return.
Okay,
So I do have to do a final tax return
for
for
Dad.
my father.
Yep. Mm-hmm.
Okay. All right.
All right,
Okay.
and our phone number at the office 632-7886, and our website is EGTax886. And there's no charge. Happy to help you. What I'd suggest you do is go to our website too if you ever need any other help. EGTax.com. Okay.
Excellent.
Thanks,
you very
Chuck.
much.
Bye-bye.
Okay.
Sorry to hear about your dad, by the way. Thank you. Okay, and that's part of what we want to talk about. Houses are so difficult.
What a quandary.
If you're, and again, anybody want to talk, 8030930, 8030930, star 930 on your cell phone. If you're selling your personal residence and you lived in it 2 out of the last 5 years, and that's why Chris asked, did anybody lived in Dad's house? Because had Chuck lived in his dad's house, well, then that would have been part personal and part rental.
Yep.
Right, and the first $250,000 if you were single would be tax free again, and $500,000 married filing joint. So it's really important if you lived in the house that would be part of the information, because that changes how it's taxed.
Yep.
Now, if the property is inherited and it isn't gifted, like what was happening on Chuck's thing, then the fair market value at the time of the
That's
don't
what the basis
right
is.
it gets stepped up, so you end up paying basically no taxes.
And actually, they could have almost put the house back in Dad's name before he
And I
passed
will
away.
tell you, that's what, to me, if you're somebody that had a life estate, and God forbid your parents that they don't have long to live, I would have them gift it back to me now so that I can inherit it, as opposed to having it gifted, because now this estate is between the three of them, we're going to pay out $17,000 that they didn't need to pay, right?
Yep.
And so everybody does. It's a yin yang. We're putting it in the life estate because we don't want the nursing home to get it, okay, but then the IRS gets it if you do put it in the kid's name as a gift, because then the basis goes back to the original basis plus improvements. So,
That's right.
I'm Esther Goulias, the tax lady, 8030930, 8030930, star 930 on your cell phone. We're going to take a short commercial break. We'll join you with your phone calls on the other side.
In the nation, they go by Guardian, Lifesaver, and Friend. At Nationwide Insurance, we just call them agents. We put members first because we don't have shareholders. Join the nation that cares.
Nationwide is on your side.
I have an insurance agent who cares. That's why Bill Barber has been my agent for 15 years. For any insurance needs, call Bill. 688-2199.
Nationwide Mutual Insurance Company and Affiliates, Columbus, Ohio. Subject to underwriting guidelines, review, and approval.
Okay, he did America. This is Canada.
This is the Goo Goo Dolls.
The Goo Goo Dolls. All right.
From Buffalo.
Yes.
Yes.
which is in America.
Yes.
Yes, that's the only connection.
Connecting the dots.
I'm Esther Gulius, the
degree of
tax lady
separations.
from EG Tax, and we're talking taxes, and we have Larry from Buffalo who's been waiting. No, Kathy from West Seneca. Hey, Kathy, how can we help you?
Hi, Esther.
Hi.
Esther, can you tell me if a property was initially used for rental purposes for, say, approximately 10 years, then it was dormant, it was unoccupied and unused for, say, another 10 years, and the owner decided to use that property for their primary residence, would the owner still have to claim the depreciation?
Yes. The depreciation never goes away. Because you got to understand, you ended up with a tax write-off all those years. And that adjusted the basis. So when we're talking about adding back the depreciation, effectively that's what happens on the tax return. But the truth is your basis goes down. So if you had paid $100,000 for that property and you had depreciated it down to 80, even though you paid 100, the IRS assumes you only paid 80. So it looks like they're adding back the 20,000 in depreciation when really it's adjusting the basis down. It's 6 of one, half dozen of the other. But yes, depreciation you claim never goes away.
So when they sell that property is when they're going to want to recapture that, Kathy.
Right.
I see. So it really wouldn't be advantageous then for the owner to use it as primary residence.
Well, yes, because all the appreciation. Let's say, let's go back to that $100,000 property. That let's say it was 100 depreciated down to 80, and from the 100,000, it's appreciated to 400,000. The first 200, and they're married filing a joint return. The gain being under $500,000 is going to be tax free. The only thing they're going to pay taxes on, and that is the depreciation.
I see.
So they're going to make out like a bandit.
Okay. All right. So if they live there, then that can be the primary, and then they can.
Right, but it's like the monster in the closet. So here it is. You never have to deal with the monster till you sell the house. But the great thing is, if it was personal residence, it was turned back into personal residence. Then the gain for the personal portion is going to be excludable up to $500,000. But the depreciation claimed has to be taken into consideration. When you open that closet and you're cleaning everything out, here comes the depreciation. You're going to pay taxes on that. Now, on $20,000, they might only pay $3,000 in taxes. So that's or less.
I see. Okay. Well, thank you so much, Esther. You're so helpful. I really appreciate it.
All right. Thanks, Kath.
Thanks again.
Have a good day. Bye-bye.
And something to point out on that same note is, say that person was never taking the depreciation long time ago, you still have to pay for it even though you were never
because
taking
it's depreciation allowed or allowable. Right. So if you're supposed to take it,
right,
then they still make you add it in as income.
Yep.
You know.
So take it.
So all right, so personal residences now, if you remember, we keep talking about this $250,000 and $500,000 thing. That's only if you lived in the home 2 out of 5 years as your personal residence. Or there's an exception. Or what, Chris?
Or you had to sell your house because of your job relocation.
Or you became sick.
Yep, medical
Some
reasons.
really good reason.
Yep.
Then what they do is they allocate the number of months that you're in the house, and then they allocate that against the $250,000 and $500,000 gain. So again, it's really important to know the tax law because
it can help you.
Right.
It will most definitely help you.
All right, we're going to go back to the phones and we're going to talk to Larry. I was almost going to talk to you a minute ago, Larry. How are you? How can we help you?
I'm just fine, thank you. Regarding a property exchange, I forgot the number that it's called, but
1031.
Okay, if I were to sell property privately, can I still do an exchange with the profits?
Okay, so it's got to be business for business, rental for. In other words, it's got to be something that's used for business, whether it's rental for rental or investment for investment. It can't be personal to personal. Okay.
I understand.
All right.
I understand.
So yes, if you do a 1031 exchange, then the gain from property A goes and adjusts the basis on property B, and until you sell property B, you're not going to pay the piper.
Okay, so I can still sell my homes privately and still turn the profits
Well, let's help me with privately, Larry. What does it privately mean?
I mean, without a realtor at this point.
Oh, sure, but you're going to need an exchanger.
Okay, on the other end, correct?
Well,
and you only have 60 days. 60?
Yeah, I'm going to need an exchanger on the repurchase of something, correct?
No. Okay. You can never, on an exchange, you can never take the money. All right? If money touches your hands, then it's taxable. Okay? So what happens with an exchanger is you say, I got this property here in Buffalo that was a convenience store. And you say, Fort Myers is calling me. So you go down to Fort Myers and you find another convenience store. So you get somebody to buy your convenience store up here. Then they say they're going to give you $500,000 for the sale. You cannot touch that $500,000. It must be handled by an independent third party who's going to take title for 1 minute for your property in Buffalo. He's also going to take title to the property in Florida. Then that exchanger does everything, and the cost basis in Buffalo goes to becomes the adjusted basis in Florida. But if you touch the money, whatever money you get is going to be taxable. So really, you need an exchanger. And Russ Gullo's who we suggest.
Very good. Great answers, and I appreciate it. Thank you much.
All right. Thanks, Larry. Bye-bye. And so those are things, sometimes, what we don't know can really hurt us. Right.
Yep. I thought you did a great job of explaining it beforehand. And you got to dig out all the things in the closet and find out what you got and settle it up. And the best thing is education.
And the saddest thing is when you have somebody comes in and afterwards. And it's so sad. And they tell like the guy that was telling us the story about his dad's inherited property, and we thought we had the answer, and then he says, "Then I rented it." Oh,
it was like my client.
And then it was sold in your dad's estate. Oh,
right.
So that changes the answer because that's how the tax law is. I mean, you have this simple answer, and then each thing that happens, it's like unpeeling an onion,
Yeah, and I had a client a couple of weeks ago who took $150,000 out to buy a house, and so he did it afterwards.
Out of his pension.
Yes, and he's under the age
and that's
of 59.
very sad. That's sad. Okay, and we're going to go back to the phones and talk to Ida. Hey, Ida.
Yes, good afternoon.
Hi.
I'd like you to explain to me about extensions. We filed an extension for filing. Would you please explain that to me?
Sure, Chris, explain it.
Now, this is just your personal return, right?
Yes, it is.
Okay, so then what you did, you extended the timeline to file your paperwork till October 15th.
Till October 15th?
Yes.
I should have all my paperwork before that.
You have to have it into the IRS by October the 15th. But explain about the tax bill.
Right. If you owed them money, you had to pay them the money by April 15th. Okay, with the extent
by April 15th of this year.
In other words, the extension was done on April the 15th for October the 15th. But the extension is only good if you pay the liability that is going to be done in October.
Okay, I didn't know whether I owed or not because this was a sort of a quirk that came up. They had my husband passed away, and I didn't know that he had some stock, and all the stock had gone to the state as abandoned or whatever they call it.
All right.
And then all of a sudden I get a letter saying that they sold the stock and they mailed me a check, and that's why.
Okay, but Ida,
income went up.
When did you get the check from the state?
In let's see. Last year, the 13th.
All right, in 2013.
Yes.
So
was it before or after your husband passed away?
After.
All right, so basically she inherited
it.
So that's going to be basically you're going to have a stepped up basis on the stock, Ida. You weren't on the title. Your husband, it was all in your husband's name.
Well, we had both a separate will and.
No. The stock was owned by your husband?
Yes.
All right, so she inherited it. So basically, it's not going to cost you anything in taxes, Ida. You got to do the Schedule D and put it in, but you're going to get a stepped-up basis, and it won't cost you anything.
So it sounds like you were correct to not mail any money in with your extension.
Right, so you'll be fine.
Oh, I should have mailed somebody, or
No, it
No,
sounds like
it sounds
you
like you're
didn't
fine.
have to,
Sounds like
unless
you're
you
fine.
have
But you got to
a
report
taxable.
it. That's all.
Oh, I have to report that. So, I see. Oh, and okay, one more thing I would like to know about housing. Now, is it better for the children to inherit or to be gifted?
Well, the truth is, it's better to inherit it if you know that you're not going to go into a nursing home. But if you go into a nursing home and they need your asset, or you have lots of income, if they're going to lien your home, then you could lose your home unless it's gifted to them. So it really comes down to when you have to take a look at your assets and say, I have a lot of assets. If I go into a nursing home, they're not going to take my home, and then my kids can inherit it and there won't be any taxes. If this is your primary asset and you don't want to lose the asset, then it's best to gift the home to the children, because in that case, the asset, after the 5-year look back rule, the asset will go to them whole. They'll have to pay some taxes on it. So if they want to have anything, and this is your only asset, gifting it to them is what you would do if you're afraid about a nursing home. Okay?
Uh-huh.
Thank you, Ida. I'm Esther Gulius, the tax lady. If you need the best tax help for the most reasonable prices, you can call EG Tax at 632-7886. Visit us online at egtax.com. If you need us during the week, we're there to help you. Have a wonderful week. Stay warm. Bye-bye.